Could a new oil shock hit your portfolio, and what can you do about it today? As tensions climb near the Strait of Hormuz, markets are pricing a fresh risk premium into energy, inflation, and rates. The focus has flipped from weak demand to fragile supply. About 1/5 of globally traded crude moves through Hormuz. Any interruption, even brief, can ripple through shipping, refining margins, and the price you pay at the pump. With central banks wary of sticky inflation, volatile oil could delay rate cuts and jolt rate-sensitive assets. Here's what's changed under the surface. Risk is concentrated at a single choke point that handles roughly 17 to 20 million barrels a day. That's a lot of supply pinned to one lane, which lifts the odds of a tail event. Spare capacity in OPEC Plus is often cited near 3 to 4 million barrels a day, mostly in Saudi Arabia and the UAE. Helpful, but not a full backstop if flows through Hormuz stumble. Logistics can tighten the screws fast. A typical VLCC carries around 2 million barrels. Delays, diversions, or insurance exclusions can strand multiple tankers and push up prompt prices versus longer-dated contracts. And the macro math bites. A sustained $10 rise in crude can add roughly 0.1 to 0.3 percentage points to headline inflation over a year, complicating the timing of any easing cycle. Traders are already paying up for security of supply. Even without a full blockage, more naval patrols and higher freight and insurance costs thin spot cargoes. Downstream effects vary. Refiners with flexible feedstock access may see stronger margins. Those dependent on Middle East grades could struggle to source barrels. Consumers feel it quickly. The U.S. alone burns about 9 million barrels per day of finished gasoline seasonally, so price pass-throughs can dent discretionary spending. For investors, sector impacts diverge. Upstream producers with low costs and solid balance sheets benefit from higher realized prices. Integrated majors may be cushioned by upstream even if refining is mixed. Airlines, shippers, and petrochemicals face margin pressure from higher fuel and naphtha unless they pass costs through. Practical takeaway: stress test portfolios for a higher, choppier oil path. Favor quality energy producers and integrateds over high-cost names. Consider inflation hedges like TIPS and watch break-evens. Review exposure to fuel-sensitive industries and look for firms with strong hedging or variable fuel surcharges. Keep dry powder and avoid over-levered cyclicals until volatility settles. Read the full article at finlitica.com.